Good morning, everyone. I am so excited to introduce to everyone. I think we're in for a real treat. We have Claire Curry here. She is the Global Head of Technology, Industry, and Innovation at Bloomberg NEF. That's a big job. And so when we were catching up earlier, she sort of wears two hats. The first hat is around specifically investments and capital deployed and understanding where innovation dollars are going. And the second hat is around understanding the trends around industrial decarbonization, the hard stuff, CCUS, steel, petchems, cement, recycling, et cetera. So we have a real expert here who's going to walk us through some of the exciting new changes and updates on the investment side, innovation side, and the technology side, all related to decarbonization. So thanks for being here, Claire. My first question is actually, we're going to have a couple of slides.
Yes.
And I wanted to kind of tell us a little bit about capital deployed. I think that Bloomberg NEF just had a Q3 report that just came out, hot off the press. If you guys are not subscribers, amazing content. So can you tell us a little bit about like the capital deployed in the private markets?
Yeah, absolutely. So nice to be here. Hi, to everyone I've not met before. Part of what my team does at BNEF is publish these quarterly outlooks that really show where venture capital and private equity money is going. So it's not just the VC deals, it's also things like the growth capital that's actually funding some of those projects that Mark just talked about. And I wanted to start off just by showing maybe two charts, because I think this is going to be framing our discussion quite well when we start talking about the hard-to-abate stuff. Q3 actually wasn't bad. I know that the global VC news is a bit down right now, but actually startups in our space raised about $16.6 billion in the last quarter. Pretty good. It's 19% up on a 4-quarter rolling average. Now, the obvious thing you can see here is all the blue. That's the energy sector. Actually, 70% of what was raised this last quarter in the blue was lithium-ion battery startups. And that's really a big China story. Actually, Chinese startups are responsible for $4.5 billion of this. So about 30% of that bar is China, about 30% is US, and the other 40% is the rest of the world, mostly Europe. In fact, what I actually did was I split this out I just pulled out the Asia funding to talk about kind of Europe and Americas, because I think it shows there the big chunk we're seeing in the purple, transport and energy in Asia, which is predominantly mainland China. And on the right here, you're seeing obviously smaller numbers, but actually a much more even split. Now, we track 6 big sectors. I'd say these are probably sectors you're all investing in: energy, transport, industry, buildings, agriculture, and then also this idea of climate and carbon, which is really things like everything from carbon accounting through to direct air capture through to nature-based solutions. And you can see here we are, energy has been doing well. Transport is interesting. A lot of the shrink in transport on the right-hand side is we're more investing in the West in things like mobility models. In fact, there was only one deal in the whole of the last quarter on anything to do with shared mobility. So I think that ship has sailed maybe when it comes to some VC investing. The good news is for industry, which I think we're going to talk about a bit more, the industry startups raised about $2.9 billion in the last quarter, which was 84% more than the previous quarter. It's good news. The reason that is, though, is because 1.6 billion of that was actually just to H2 Green Steel. So those of you who are in Europe, you've probably heard lots about them. They raised a huge private equity round to help fund their first-of-a-kind green steel project, which is basically a hydrogen project. So that's the majority, actually, of that industry funding. My final comment would be that although most startups are raising money in energy and transport, the most active VCs with the most number of deals, I guess is what active means for us in this space. So Breakthrough Energy Ventures, Microsoft Climate Innovation Fund, Prelude, Lower Carbon Capital. Those are the top 4 from last quarter. Almost every single one of their deals were in industrial decarbonization or building decarbonization. And those 4 together were involved in over half of the industry deals. So there's some cool stuff going on in industry. It's not nearly funded enough, but actually it's really a very few number of VCs that have a slightly interesting remit a lot of them are backed by billionaires, which helps. So that's kind of the skew and why things look the way they do. And I hope pulling out the China stuff actually shows better where Europe and Americas are going.
Well, it sounds like we also have to pull out H2 Green Steel, because that's
Yes.
a huge outlier as well.
Northvolt was, I think, raised, almost $1 billion the last quarter too.
Yeah.
So that's huge, yeah.
But it's fantastic. So, one of the questions we all have is, at CI, we care very deeply about greenhouse gas emissions and putting our capital to work to reduce those greenhouse gas emissions. Looking at the data here, are we putting capital to work where the emissions are happening?
Yeah, I guess you maybe already know my feeling about this, given I cover industry, but in 2022, the VC market, our world spent about $2.8 per ton of CO2 emitted on energy, so it's tackling energy. That's transport actually, $2.8 on transport. It was only $1.3 on energy. So we're spending twice the amount of VC capital on tackling the transport problem, which is great. Transport's a huge emitter, obviously. Energy was $1.3. Agriculture and buildings were about $0.7 per ton of CO2 emitted.
Combined?
Each. Industry was $0.4. So we are spending only $0.4 of VC money on every ton emitted by industry compared to 2.8 for transport. Now, I would suggest that maybe we need to think about the role of VC. The transport sector, in BNEF's view, is we know where we're going. We're electrifying it, basically. Yes, we have problems with SAP. So aviation and shipping have their own issues, but with road transport, we know what we're doing. And to be honest, the companies that are going to make that scale are a lot of Chinese battery companies, maybe a couple of Europeans, and then a bunch of car companies. None of those are VC bets anymore. So I would suggest we are underinvesting in industry, buildings, agriculture. And the sad thing is buildings, we spent VC money went into about $500 million into building startups the last quarter. That number has not changed in a whole year. We're not investing more money every quarter in buildings. In agriculture, it has shrunk considerably. I don't know if it reflects it well here. Agriculture is the red. Ag had a good year last year. It's had a very bad year this year. So I think we're going backwards on some things, and I suggest we don't need to be investing quite as much as we are in transport. Although really, we should be investing many, many dozens of dollars per ton of CO2 in all of this, I guess, yeah.
Yeah, well, the one thing that's really nice from a trend perspective is we're seeing non-climate investors coming into the climate sector. But I think one of the things that you're highlighting is more money needs to go, especially to industry, buildings, as those are big problems. And it looks like agriculture was okay, but is off the charts again. So maybe a focus from an industrial agriculture perspective. So maybe we can talk a little bit about on your technology side and innovation side, and why are these sectors hard to decarbonize, and where are the opportunities for early stage investment?
Yeah, obviously there's a reason why VC dollars haven't been going to these sectors. Industry is B2B, and it's a lot of big corporates that don't want to move, and a lot of these are mini monopolies, right? It's 5 or 6 companies that control, Europe's cement market or Europe's steel market. The big things, I would say, what are the really big things we need to be decarbonising right now? Cement is 9% of the world's emissions. Steel is 7% of the world's emissions. Ammonia, fertilizers, is 2%. Aviation is only 2%. And we talk about flying and planes and decarbonizing aviation so much. But cement is almost 5 times that. And oil refining emits 4% of the world's CO2 just from refining the oil, never mind burning the oil in cars. So we should be talking about oil refining decarbonisation twice as much as we are aviation. And shipping's about, 1.5%. So together, that's a lot. Industry makes up, as you know, about 24% of the world's emissions. Agriculture, who knows? It's anything from 14% to 25%, depending on what you include. So those are the big things. I think we all know why they're hard. There's, in our cost analysis work, even in a great scenario where we actually have green hydrogen and we actually have 24/7 clean power, we are still not making cost-competitive net zero steel or net zero cement in 2040 without subsidies or green premiums. That's a challenge because right now we can actually build an EV and we can build solar and wind that are cost-competitive in some markets. Right. So if you're not making money, then how do you get your first-of-a-kind project funded without government support? That's why we're not seeing investment in this stuff. if we get a chance to talk about it later, I think H2 Green Steel is a great model about how to build a first of a kind. And they're doing it, touch wood, well. But yeah, there's no money to be made. So I think the key thing for me, and what we can hopefully talk about a bit, is policy. Like, I think if you're investing in these spaces, you either have very rich backers who don't care about returns, or you have to follow the money, which is where policy is. That's why Europe is super exciting right now, because the introduction of CBAM in 2 years' time, and the EU ETS finally including industry, transforms this story. Like, we just published some research last week that showed that the average oil refinery in Europe under EU ETS in 2030, and only half its emissions will be under the US tax in 2030, will owe $100 million in carbon taxes every year. To decarbonise that facility using green hydrogen, some electricity, efficiency, and CCS will cost about $20 million. So, like, you're making huge amounts of profit, money, by doing that, and investing, therefore, in CCS suddenly makes sense. Same with cement. Holcim came out this week and said they're basically investing in CCS in every single one of their cement projects, and they're going to make tons of money from it. Because not only can they charge a green premium, significant green premium for green cement in Europe, they're also otherwise facing huge carbon taxes.
Right.
So that's what's exciting. I think Europe has this real potential to actually make money, finally, from tech that decarbonizes industry.
So maybe for the rest of the audience, virtually and here, maybe talk a little bit about CBAM, just to say what it is and share your thoughts.
Yeah.
It's really exciting.
Yeah, it is. And actually, I don't have a slide on CBAM, but I will leave something up on industry because we're talking about it. This is the industry funding, just so you see how we break it down. So yeah, crash course. The EU ETS is Europe's carbon pricing market. As we all know, the carbon price hovers around 80 euros a tonne. We're predicting it's going to get to about 140 euros a tonne by 2030. That begins to finally make industry decarbonisation and other things, building decarbonisation, profitable. But to date, industry has been given all these free allocations, which means even if I'm emitting tons of CO2 as a cement mill or a steel plant or a fertilizer manufacturer, I don't pay any of the taxes. And that's done for various reasons, mostly protectionism and a fear of carbon leakage, i.e. those plants just move somewhere else. The EU ETS is beginning to include, from 2026, or remove some of these free allocations, basically. So by 2034, which sounds like a long way away, all industry in Europe will be under EU ETS, which suddenly makes all this stuff incredibly expensive to emit. CBAM is the carbon border adjustment mechanism. It is a way of stopping that carbon leakage. So basically, if I'm Holcim and I'm emitting a ton of cement emissions in France, I could choose to move my cement mill to India, right? And just, well, actually, cement is a really awful example. You don't ship cement. Steel, so ArcelorMittal, and I'm in the Netherlands, I could choose to just build more steel in India, and I could ship it to Europe, and I'd avoid the carbon tax. CBAM will put a tax at the border of the EU on your carbon footprint. So if you're emitting more CO2 in your Indian steel than you are in your Dutch plant, you get taxed, as if you were in the EU ETS. Obviously, people hate that. The US is now looking for an exemption across all of America, right? This trade deal they want to make to prove that now we're doing stuff on climate, we can be exempt from CBAM. We think that's incredibly unlikely Europe's going to approve that. So it actually will account for everything we import, which is really cool for buildings too. Like your next panel, this idea of building materials will matter because we're making it here or we're importing it. Either way, it's going to be carbon taxed. So that's why that's exciting.
Yeah, it's very exciting. And it's Europe versus the US kind of from a policy and regulation perspective is always, it's a little bit of a different animal, right? We talked yesterday with Michael, he spoke about the IRA, and Mark mentioned it this morning that, without the funny bits and because, there's a lot of stacking of incentives and it's very subsidy driven. I think in Europe there's a lot of mandates. This is where we'd like to get on SAF. This is where we'd like to get for heat pumps. This is where we'd like to get in terms of numbers of units deployed or amount of carbon emitted associated per unit of product. What else do you think, from a policy perspective, could really help spur the investment ecosystem to say these are good places to put your money in European companies with mandates, but also potentially other policies or other grants? And what are you seeing out there?
Well, I think the European Union has said that they have more money available for scaling the transition than the US has put on the table. The challenge is IRA is super easy to access. It's It's very easy to understand. It's a tax credit. Everyone gets that. Everyone will apply for it. The European money, I think as we all know, is very hard to understand. It's in a lot of complex funds. People in the know can get access to it, and that's why the European Union's funded steel mills in Europe, 4.5 billion euros this year. I think Holcim alone has received 850 million euros to decarbonise its plants, and yet startups say they struggle to get access to the money they need. So a lot of the European money is just, if you're in the know, you know the right people, you can apply for it and so forth.
So I just want to repeat that for the audience, because that is a huge number. $4.5 billion for green...
To about 3 or 4 steel companies.
To 3 or 4 steel companies in Germany.
Yeah, just in Germany.
Just in Germany alone, probably an energy security issue as well, and job security, et cetera. But it's the large companies that are getting this, 850 million euros for one company to make green steel.
Yeah, the UK is doing the same thing. The UK is saying we're going to fund hubs, and we're going to give billions of dollars, or euros, pounds, to these hubs to decarbonise CO2. I think that's a great strategy, but the companies they're giving the money to are big oil and gas companies, big Indian steel companies. Holcim again, and a few others. So yeah, it's definitely hard, I think, in Europe as a startup. Whereas in the US, you could be anyone, if you've got the money and you can find the money from somewhere to build a hydrogen project, you can get the tax credit. It's a neat solution. But I do think that what the US is really missing is demand side. I don't know if Michael talked about this yesterday, but US policymakers agree you have all these great subsidies, but still no one's building this stuff. I mean, I know we're still struggling. We're still trying to work out what the green hydrogen is in the US, but even then, there's so many million tons of green hydrogen projects waiting to get built. Even if they're cheap, if there's no demand, then no investors are going to come. You need the offtakes. I think what Europe is doing, I don't know if you guys know this, but Europe, earlier this year, basically said we are going to mandate that every single user in Europe of grey hydrogen has to turn 42% of that to green by 2030. So that's a mandate. It's not everything, but it's about half. And that basically means that oil refiners, fertilizer companies, methanol producers have to shift to basically cutting their emissions by that 40%. And that, with a target that's 6 years down the line, I think that drives investment. Maybe the startups miss out, and I don't know if it's a place for VCPE, but it does drive institutional investment because these big companies have to change. Very different from what the US is doing. Although the US now obviously has announced these 7 hydrogen hubs they're going to fund, which is great. And so there is some demand side stuff going on there too.
Well, you know, and also from a VC perspective and an investor perspective, we think about sometimes these large companies maybe getting the subsidies and know how to access and deliver the mandates. But they often have innovators' dilemmas, challenges, and they need to move faster. So potentially they will be partnering with new technologies and innovations from startups. Yeah. So still a really interesting area, it looks like. Yeah. I want to talk about, you mentioned it slightly, about green premium, right? And how, if you talk about Bill Gates, you know, he often says you want to be able to get your solutions without a green premium. We're obviously not there today. If you're talking about 42%, you know, from renewable energy, hydrogen from renewable energy, that's going to likely be at a premium to others. Maybe you can share your thoughts a little bit about getting that green premium. How long does that last? Is it kind of a first of a kind, second of a kind, and then we will get to a period where, you know, the green premium goes away? Like, how do you see that sort of playing out from a cycle of deployment?
I guess I have a different view from Bill Gates because I think the green premium is here to stay for lots of materials, and that's not a problem. You look at the amount of people queuing up to buy green steel. They're paying 150 to 200 euros a ton premium. That's significant.
That's huge.
Cement will be similar. Cement's probably even harder to decarbonize. You look at recycled plastics, the premium there is very significant. That's needed because otherwise the returns on their projects don't get built. But B, no one's complaining about that. They're saying, actually, what we need to do is get smart about how that filters through to the customer. So green steel, 2% of a high-end, you know, German Mercedes-Benz, let's say, is the cost of the steel. So if the green premium is a 20% cost on top of that ton, you're really only, sorry, that's not entirely true, but the steel is obviously more of a cost, but in the end, to the consumer, really it's about 2% of the cost once you think about the sticker label of the Mercedes-Benz. we are seeing German car companies particularly and Italian car part manufacturers queuing up to buy steel from the H2 Green Steel project. Because for their customers, it doesn't change the tag of the price of the car, really. But A, these companies all have scope 1, 2, and 3 net zero goals, which they're committed to. And B, they can pass on that cost ultimately to the customer, and they don't care. It matters massively in building. Like, you probably can't pass on the cost of that green steel in a building that's mostly steel. But actually, 25% of the world's steel is bought by governments. And many governments, including the US, have this new Buy Clean initiative. Many European governments are following suit. For them, steel costs in their projects for a new tunnel, for instance, is a few percent. So again, that green premium kind of goes away. It is more money. Obviously, someone has to absorb that. It's the taxpayer or the consumer, ultimately, in a democracy. But it's not huge. You could get scared looking at the price you're paying for the steel out of the mill. But actually, when you look at the price we're all paying, I think it gets absorbed. And I don't want to be obviously, the cost of living is it's increasing. Inflation has made living in Europe and the UK very difficult. But I think we're going to live with a green premium for quite a lot longer. Things are going to get more expensive. And we have to work out, who absorbs that. But it shouldn't stop projects being funded. We cannot wait to start funding first of a kind.
Oh, yeah, and absolutely. First of a kind, we can go into a long discussion about this. You know, what are the best sources of capital for first of its kind? Is it venture capital money? Is it project capital money? Is it, institutionals from, public institutions? What are you seeing for, on the European side for first of a kind?
Yeah, well, I think the key thing for first of a kind, which is not a surprise to anyone, is it has to be bankable, which is two things, really. Reducing technology risk is essential, and then proving you can get an IRR or a return that people are going to invest in or give debt to. I think what startups have learned is a few things. One is raising project finance is important. Try and avoid, I think project debt you can get. I think getting debt as a startup is basically impossible. But getting project debt is actually doable. You need some sort of loan guarantee from the government. That helps massively. Not always feasible, but I think European governments are giving that out. Obviously, we have the Loan Programs Office in the US, although it's slightly flawed. Then you have this challenge of, well, how do you prove your returns? It's really about signing offtakes for the product and for any input. So if you're, again, H2 Green Steel, they have a long-term offtake signed for their renewable energy, which means they have the hydrogen price guaranteed. And that's a huge input cost for them. They've also got offtake signed for over half now of the steel they're going to produce, or the iron and steel they're going to produce. Again, my understanding is fixed price at the premium they've set. Now, they've designed that price premium to meet the returns they need to guarantee the funding they're getting. So most of their project is debt. They're raising it at the project level. That makes the debt expensive, but it's actually feasible. As the company themselves, they can't raise debt. We've talked to some startups building green methanol projects in Europe for the first time. They're being mobbed by shipping companies that want to invest equity as a VC kind of model into the startup, and they're saying no. We don't want to take VC PE money into the startup. We want to run the startup almost just self-funded. We want to raise equity, project equity at the first of a kind project level, because they're worried about being controlled by the Maersks of the world at the company level, but they really want to raise this project equity. So they're getting smart about that, raising the debt. The challenge with industrial products is most of them don't normally sign long-term offtakes. In shipping, aviation, and steel, most of these deals are ammonia. They're 1 or 2 year deals, not at a fixed price. They tally with the price of oil or the price of whatever it is, steel. And so signing a 7-year fixed price offtake for steel or ammonia is insane. So I think you also need companies who care. And I think H2 Green Steel, final point, is a huge amount of their offtake is also their investors. That really helps. And that's actually the LNG model. I mean, those of you involved in oil and gas, the LNG industry got going because Japan needed stable energy. It didn't have any. And the Japanese government and the trading houses in Japan were willing to be investors in these massive LNG terminals and sign fixed price offtakes. Without that, no one would have spent the $1 billion for the offtake terminal. So I think we need to just, maybe that's a cliched story and it's been told many times before, but I think that's what we need to go for industry is find investors who are going to be off-takers. And really, those are the companies with scope 1, 2, and 3 goals.
Yeah.
And again, Europe has loads of those. So I think follow the money on policy, but also follow the money on who are the companies who have set strict scope 1, 2, 3 goals. We have a database of about 1,000 companies, and we're tracking all of their goals and where they're going, and are they hitting them through whatever it is, SBTI targets or other things. I think those are the ones to chase. And that actually opens up some exciting investment opportunities, I think, in certain niches where VC can actually play. I mean, not first of a kind, but I have no idea what the time is. Have we still got time to talk about
we have just about a minute left. I know that we could just talk on and on. I think this is one of the very, very rich content, lots of really interesting things. But maybe I'll just open it up if we can take one question from the audience, if there is one, and an arm is up, please.
Thanks so much. Really interesting conversation. Appreciated the discussion around first-of-a-kind financing and project finance. I think what we've seen, at least, is VC-backed startups with technology that is not even close to, or I would say that still has remaining development to get to TRL 9, like maximum tech de-risking. Right. I would venture to say that they're never going to access project finance. Like, there's just still too much risk there. So when we talk about this, full capital stack for climate VC and climate investment, how do we get those project financiers into the conversation? Because our experience has been that they're not interested, too risky.
Yeah, that's a great point. I mean, maybe this is a question more for you, actually. What do you think?
So I was going to say, we have 30 seconds. I'll be very quick about this. I think one of the things that Claire mentioned is the emitters, right? The emitters, the folks who are in the corporates, and perhaps they have, capital to support, both on the offtake as well as on the technology risk side, on the pre-TRL. I'm seeing some industrials kind of step up. They all have these net zero goals. And so that might be sort of partnering, bringing in financial investors, bringing in industrial kind of corporate investors on maybe their CVC arms. And then it sounds like in Europe there's really great access to possible governments and government funding, and kind of stitching it all together maybe to do the first of a kind. And then, I struggle too to see like how can we fund those first of a kinds, and maybe that second of a kind and third of a kind we can find project equity.
Yeah,
so
I know we're out of time, but just I think it is worth mentioning a few things really briefly. I do think there is exciting opportunities to invest in proper VC startups that are pre-commercial. I'd say industrial heat is one, because often companies in Europe, the only part of their scope 1 they can't squeeze out is heat. And they're buying biomass at crazy prices. So they're very willing to pay premiums. And if we can serve them better solutions like electrification, for instance. Secondly is circular economy. We're just beginning to see Europe really turn the screw on waste plastics. There is so much money to be made in AI and robots and sorting and spotting waste, because the premium people will pay now for waste plastics and waste steel to go into EAFs is very significant. And just look at UK policy and what they're doing here on waste plastics, it's amazing. And then that speaks to, I think, also finally the construction demolition waste, which sounds very unsexy, but we have increased the amount of waste cement and concrete by, I think, 300% that we're producing every year in the last 30 years. And this is a US stat. There are so many cool prefab, like modular building companies and prefab building companies, I'm hoping you'll talk about in the next panel, who are doing really interesting things to reduce waste at the building level. That is going to be so important, because we are seeing not only US and Canadian, but also European cities begin to mandate emissions reduction for life cycle in buildings. And those are really, they're going to get really strict in the next decade. And those are exciting spaces, I think, to look at. And I'm going to, sorry.
Nope, that's fantastic. Thank you so much. I mean, I heard, right, industrial heat, buildings, and circular economy on the plastics. Guys, like, Joel, write that down. Fantastic. Thank you so much, Claire, for your time. Please help me give her a great round of applause.